I think what has come as a bit of a surprise is how quickly it's come back down to earth. And what worries investors a little bit on this front is that those lock-up periods, which were supposed to ensure that we didn't see large-scale selling from existing holders, they haven't expired yet. So we will anticipate a fair bit of selling from insiders in 6 and 12 months' time.
Gemma Dale, welcome to the business.
Thank you for having me.
For investors, oil and AI seem to be two big themes, and SpaceX IPO price really came back down to earth this week, falling below its IPO price.
Yeah, I mean, this is not a huge surprise. This was very hyped. It's an Elon Musk company. It had so much hype and PR behind it. But there were a lot of pundits who were concerned that the valuation was extraordinary and that a lot of the forecasts, we'll call them forecasts, were potentially illusory, right? It's very difficult to price a company like this that's not profitable and it's got a lot of quite extraordinary anticipated outcomes baked into where the valuation was set initially. I think what has come as a bit of a surprise is how quickly it's come back down to earth. And what worries investors a little bit on this front is that those lock-up periods, which were supposed to ensure that we didn't see large-scale selling from existing holders, they haven't expired yet. So we will anticipate a fair bit of selling from insiders in 6 and 12 months' time. It's a bit of a surprise to have seen it happen so early. The other issue is that the stock has been included in the NASDAQ 100, and another part of the story behind why this was a bit of a slam dunk, if you were bullish on the stock, was that it was going to be included in that particular index, and then you've got the S&P 500 and MSCI World to look forward to as well, and that's going to give you a whole lot of passive money and that's going to elevate the share price. Well, NASDAQ's already there and that hasn't helped. So that does perhaps give investors a bit to worry about.
Yeah, and that's really interesting because when it went to the NASDAQ, as you say, it didn't get the price bump. So was it priced to pop and then fall?
That's the question. I think, again, investors are a little, it's understandable that they're disappointed it's happened so quickly. I think a lot of people understood that there was perhaps some risk that it would fall within that sort of once the lockup periods started to expire and people were out of escrow and so on with the early holdings. That was anticipated, but there was an anticipation that as the ETFs were forced to buy and the index holders were forced to buy, with the NASDAQ in particular, that we were going to see a bump, and that just hasn't occurred.
And of course, we're anticipating other IPOs from these big AI companies like Anthropic and OpenAI. Has this done anything to dampen enthusiasm around those?
Look, I think that's a really important question. The biggest and most obvious outcome that is likely is that perhaps they won't get the valuations they want. So they can still come to market and they can still raise capital, particularly at the top end. So the high quality plays, the ones that are in the public domain and well understood as viable propositions, can probably still come to market, but whether or not they can raise the same amount of capital at the same valuation that they were anticipating just a few weeks ago, that's a different question. And there is also the question then for the less viable plays and the more speculative plays, perhaps they're going to find it much more difficult to come to market, that the hype may have drifted away and the space is just not there for them.
Yeah, and you say hype around these companies might have dissipated somewhat. I mean, we have seen tech shares being sold off periodically over the last week or so.
I mean, that's been a trend through the year. They've been pretty bumpy. The performance has been quite incredible over the last couple of years. It's not to say that those investors who are holding AI indicated companies haven't done terribly well, but it's bumpy. And clearly there is so much potential priced into these stocks. There was always the potential for them to take a pullback, and we're seeing bits of that here and there.
Particularly in Korea, which has seen wild swings on the market, which is really dominated by two big chip makers.
Yeah, this one's amazing. I mean, the Korean market is absolutely fascinating if you like watching extremely speculative, sort of more fringe players. And it's not to say their two biggest companies are fringe players, they're absolutely not. So you've got Samsung in there. But those two players, chip makers, as you say, are responsible for about 70% of trading activity. That's a lot. And there is the issue that the Korean market is structured very differently to the sort of more liquid, well-developed markets in the world. So there's a whole lot of idiosyncratic reasons why the Korean market is so speculative and so bumpy. So we see moves of 7% plus either way on regular occasion.
And the market operators had to step in and stop trading numerous times.
This has happened numerous times, as you say, because it's a highly speculative market. There's a huge amount of retail participation. They have opened up retail participation to 24 hours a day. There is so much highly leveraged speculative stuff available in that market. So they have leveraged single stock ETFs, and they've had to put a cap on the number that can be brought to market. It's a very different market to the ASX, for example, or the S&P 500. If you look at that particular index, what is in the sort of larger, well-developed markets just doesn't correlate to what happens in Korea. It's much more extreme, but we're really seeing it bounce around.
So with that in mind, it's not necessarily a tech sell-off story, but more a retail leverage story?
I think in Korea particularly, it's also worth noting, I mean, the run in Korean stocks was so extraordinary. There was always going to be a pullback. It's just the nature of the pullback is so volatile. It was volatile on the way up, and it's extremely volatile on the way back down again. So it's an idiosyncratic market. It has just sort of unique characteristics that make it far more volatile than bigger, more liquid markets that are perhaps a bit more regulated.
The Australian share market doesn't have a huge tech sector. It's about 6% of the ASX 200, but banks are very much a heavyweight, and there are concerns about credit growth affecting banks' profitability.
Yeah, we've had that question, we've had it for a while. It's been absolutely lifted by the recent budget announcements and the legislative change off the back of that. So that has absolutely fed into a couple of concerns. One concern with the banks was they just ran incredibly hard. So the share price performance of the big four was astonishingly strong. CBA remains the most expensive bank stock in the world, and the other three are performing pretty strongly from a share price perspective. Yes, they've come off their highs, but that does not mean that they are cheap by any means. And then we have these broader concerns about the Australian economy, which is soft. It's okay, it's resilient in many ways relative to the risks that it has faced over time, but it is not performing particularly strongly by global standards. And then we have the issue that the Australian banks are highly leveraged to the property sector and to housing in particular. And we have seen a very rapid softening, again, off the back of very strong growth over many decades. So this was probably an expected moderation, but it's been accelerated by the budget changes that were announced. So we've seen Macquarie come out and say they're anticipating a pullback of sort of 20-30% in volume growth for lending, home lending in particular, and a fall of sort of 50% from the investor base. We've seen Westpac come out and say they're off 20% in terms of their volume growth. We've had NAB come back and say we've seen a 15% fall quarter on quarter in terms of application numbers. There's clearly weakness coming through in housing, and that does affect the banking sector in Australia.
This week, a surprise fall in US inflation really gave investors quite a bit of confidence, at least in the middle of the week.
Yeah, it was really interesting, off 0.4% in the headline figure anyway. I think you always have to look into the detail, and that was a nearly 10% fall in energy, largely driven by oil prices, right? So a fall in gasoline, that's not a huge surprise to anyone. We saw a real moderation of tensions in the Middle East, and that has caused gas prices, as they're called in the US, to fall. But there was also a moderation in shelter, which is really interesting, and that is largely the World Cup bump. So there was a bump in Airbnb and hotel pricing and so on, that's sort of starting to drift away. So you're starting to see a softening, but the softening is coming through in factors that were elevated for quite idiosyncratic reasons. A little bit of seasonality in there, a few other factors. So you've got still the Fed chair, Warsh, coming out and saying, look, we're still hawkish. We're still very much concerned that our levels of inflation are elevated and the job is not done to bring it back to the long-term trend where we want to see it. And we've had Goolsbee say the same. So even though it was a positive figure and the market was really happy with it, I don't think we want to feel like the job is done just yet.
In terms of that inflation relief, it's likely going to be short-lived if we look at where crude prices are heading, given the re-escalation of the conflict between the US and Iran.
Look, it's really difficult to anticipate how that conflict is going to play out. I think there was a very strong view that the taco effect would play out, that Trump would have to back down. We saw that, and now we have a re-escalation of tensions. I mean, markets have learned to moderate their expectations and moderate their responses to a lot of this activity because it is changeable by the day. And the elevated prices we were anticipating and economists were talking about when the conflict kicked off never really transpired. We saw a variety of actions taken across the world to keep a lid on oil prices that may be maintained. It's a little bit hard to say it.
And Gemma, just briefly, is there anything for investors to look out for next week, or is it pretty quiet?
It's pretty quiet. It's an interesting time. Worth noting, it is reporting season in the US, so investors will be watching some of the bigger names coming through in the US with their quarterly reports. They're just quarterly. But we're ahead of reporting season in Australia. That's next month, so there's still a lot. There may be some confessions coming through, I think, from some companies that want to get those out in the public domain. BHP's obviously already done that this week, so there may be a little bit of that for investors to look to.
Gemma Dale, thank you.
Thank you for having me.